I'm Chris Preston.
And I'm Brett Zimmerman.
Welcome to Street Check, the best two-person podcast in the history of Cabot Wealth Network, which has been in business for more than 55 years, delivering investment advice to individual investors. Uh, Brad, before we get into all the investing stuff, you have an interesting weekend on tap. Tell us about it.
I am selling tacos, as is my want, as I do every year to raise
At
low to
baseball
mid
games, Major League Baseball.
at Major League Baseball spring training games. We raise low to mid five figure funds for kids to go to Disney, which is fantastic. I think I'm going this year. My wife, though, is my daughter is also in a play. My wife will be going to back-to-back showings. We both went last night of the play. My wife is going to all four showings of the middle school production of Mary Poppins. Chris, am I a bad person in thinking that that sounds a little bit like a nightmare to go to all four performances?
You're not a bad person for thinking it's a nightmare. Not you're going to you've gone to your one, and that's
I
it.
w- I went to my one. My wife is going tonight, and then my parents and my in-laws are going to one of the
Yeah.
shows tomorrow with my wife. I will be at the taco stand though.
I think one
So
is pretty reasonable. You'd like to get to two of the four, but if you have, if you're slinging tacos weight don't make themselves. Um,
I want
so
to hear from Brad what kid did the worst. Which one did you just want to close your ears and stop listening to?
that's mean. I'm
Oh,
I'm
come
not
on.
and say their name
Come
and
on.
age and
Yes. Look
I
great.
only know like one of the kids in the cast who lives in the neighborhood and is a friend of my daughter's.
yeah.
Um,
How was the Mary
it
Poppins performance?
was middle school. It was a middle school
Okay.
performance. They
Okay.
uh, they pivoted to their tech department pivoted from like local high school to the middle school, and you could feel it. You you could physically feel it when they had too much feedback in like their subwoofers that was shaking the 1,500 person or 700 person. I don't know. It's a surprisingly big auditorium at a local center for the arts, but it was shaking the entire building.
Hmm.
So.
Well, yeah, it's good for your wife. Good on your wife for going to all four. Yeah, I think four performances. I don't think any parent should be expected to go to all four. It's good that she's doing it, but
Uh, the neighbor parents of that kid are also going to all four. So
yeah.
I'm looking at this. I'm like, am I the odd one out? Am I the guy that's like, if everybody
But your
else is just
daughter's
going to all,
not Mary Poppins, right? She's not.
no,
Okay.
she's ensemble. She has no speaking roles, but
Yeah,
she has
that's
some good choreography in it.
okay. Yeah, I think if your kid is Mary Poppins or what's the guy's name? The chimney sweep.
Bert,
Uh, yeah. Then maybe all four seems reasonable. But ensemble, I think you're good.
all right, I
Yeah.
feel better about
Good.
myself.
Good. That's what I'm here for. Okay. Tell people what we're going to talk about today.
We are going to talk about something of a mixed market. We're still sort of pinned near the highs on the big cap indexes. We are going to talk about European stocks, which have been outperforming notably in the last month or so. And we're going to talk about Alibaba taking off and whether or not that might be the next name in AI. And after that, we are going to welcome on Nancy Zambell. She'll talk about investor sentiment, market, probably talk about housing, interest rates, things like that. But before we get to that, as always, Chris, you are on deck to deliver the hottest take you can think of. This week, the market is either up or down 5% in the next month. You have 90 seconds. You may begin.
Yes. So the market will be up either up or down at 5% in the next month. We've been in a tight range, at least in the headline indexes. S&P, we've been between lows in the low 6100s, actually hit a record earlier this week. It doesn't feel like it. And the high 5900s, at least on a closing basis for the last 5 weeks, basically. That's a pretty tight range. And usually when there's tight ranges like that, setups, as Mike Santola likes to call them, there's a breakout in one direction or the other. Under the surface, if I had to choose a direction, I would think down, at least in the short term, 5% or more. Um, partly because it's been trending that way the last couple of days, but also because the number of new 52-week lows um, has been climbing a bit between the New York Stock Exchange and the Nasdaq. It's 71. I believe Mike, anything over 40 usually is sort of a yellow flag, at least for him. Um, Although the number of 52-week highs still outnumbers it. Sentiment, which we'll talk about with Nancy Zambell later, has is down. There's a lot of potential headwinds out there: Fed, tariffs, earnings season ending, which has been sort of a catalyst, propping things up lately. So I think there will be a breakout coming in the next month, and I think chances are it'll be down.
All right. Pretty much hit the post on that one. Well done.
Great.
Uh,
Yeah, veteran move.
just to piggyback on that, a an analyst with JP Morgan in a research report that came out today calling for a 5% rise in the S&P 500 to around 6,400 late winter, early spring was sort of the time frame that he offered
Okay.
up for that. So you're not alone in the opinion. Yeah,
I hope it's
it's
up. I'd
tough
rather it
market.
be up, obviously. But my feeling is that there could be a 5% or more draw down before an even bigger acceleration. Possibly even within the same couple months. But if I had to pick a lane in the next month, I would say five. I would say down, and that could happen. We're already down from the highs, a couple percent from earlier this week. It could get down 5% in the next week or two, potentially.
Yeah, it wouldn't be totally out of character. We've seen the same exact thing happen with plenty of growth stocks this earnings season where
Right.
they'll trade up, hit all-time highs or be very near all-time highs and then take a, significant haircut, a 10-15% haircut on a bad results or bad guidance. So it definitely feels like the market is sort of vulnerable to that
Yeah.
kind of a pullback, but obviously the hope is we get an upside breakout and not the other way.
Yeah, and so this take rolls into slash steps on most of the first of our big three. Market, it's been a mixed market. It's gone basically nowhere for, well, if you really want to look at S&P in particular. I mean, it's flat since November. Um,
First week of December, I think.
yeah,
We're at like 10 weeks right now of no net progress.
yeah, you're right. Yeah, like December 4th, 6th.
Yeah.
It topped out at 6,090, and it is currently, as we're recording this, at 6,077. Um, so yeah, I mean that we're coming up on 3 months almost of no net movement. Um, given the run up post both in August and then after the election, maybe not that surprising, especially given all the headwinds out there. Um, I think the resilience has been impressive, but I could see, like I said, I think earnings season ending, which has been sort of the only real catalyst lately, um, could lend itself to the market, getting taking on more of a dent in the next few weeks.
Yeah, that was something that Tyler brought up in an Tyler Lawndon of Cabot Small Cap Confidential and Early Opportunities brought up in an internal meeting where he was pointing out that earnings season has really helped contribute a lot to that resilience. I
Yeah.
think as of today, or maybe as of last week, something like 16.6% earnings growth rate for the S&P 500 companies that have reported, and that was with like three-quarters of the companies reporting. Uh,
16.9 as of a week ago. The
okay.
tech set hasn't updated their data yet with, yeah, 77% of the S&P reporting. So you were close.
Yeah, and at the same time, like I was telling you before we started recording, Bank of America had a fund manager survey, and they found something like 35% of fund managers are overinvested in U.S. equities, despite the consensus being that U.S. equities are overpriced. And I think that'll lead into our next item in the big three.
Yep.
But Yeah, I mean, if you clear out all of the earnings season wins, like what other really positive catalysts have we had headline wise? I haven't seen anything that's been particularly remarkable. Um,
No,
individual companies, I guess, a little bit. Microsoft just
yeah.
announced like a new quantum chip. Apple has more developments with AI, which we'll get to. But other than a couple of headline or other than a couple of stock specific news items, I haven't seen a ton that's been super, super bullish.
Yeah. The last one was after stocks had sort of wallowed and through December and in the first couple of weeks of January was when those inflation reports came in a little cooler than expected. It was slight, but it was enough that's when stocks sort of took off for a few weeks. And then this month's inflation reports happened and it was sort of the inverse of last month, where it was slightly hotter than expected. And stocks have, at least under the surface, have there's been a bit more selling. Like when we had when we had four Cabot analysts on a couple weeks ago for our roundtable discussion, all of them said, Jacob said this sector rotation, buying on weakness. It sort of goes from one sector to the other, but nothing, and Mike wrote about this too, or mentioned this too, nothing's totally taking off to the upside. Individual stocks, yes, but sectors as a whole really are not.
Yeah, and if you're trying to anticipate, which is generally a mistake, but if you are, if you're trying to sort of game out what the path forward looks like, um, it's certainly easier to anticipate negative negative catalysts than positive catalysts. Like the Fed's not going to come out and slash rates by 100 basis points, and treasuries are probably not dropping from like 4.4 and change where they are now to like 3.9% yields, right? Like those are like the meaningful things that we would need market to see some real market wide strength. It's much easier to game out how a fresh round of tariffs or say mass federal layoffs or it's easier to game out the negative catalysts and to maybe expect downside movement. I don't with earnings season over, I don't really see what is going to fuel that big push higher.
Yeah, it feels like we're back in a place where we're just at the mercy of whatever the Fed says or whatever the inflation data shows. Tariff stuff too, but I guess that was a little bit more expected. Whereas from the last 2 months are evidence that we don't really know which way the data is going with inflation. A little better than expected 1 month, a little worse than expected the next month. I, I you know, I guess that's not that different from what it was, say, 6 months ago. It's just that the Fed is now flipped back to foe after being friend for a few months, and we're in this, stagnant period of inflation, or sorry, of interest rates, where no one's expecting cuts till at least the summer, any more cuts till at least the summer. Um, but that leads in well to our next item, which is European stocks. European stocks Europe 600 is up more than 8% year to date, more than double the 3.5% gain in the S&P and Nasdaq. Um, I wrote about this the other day. There was a Bank of America survey from earlier this month. And it said, fund manager survey. 34% of fund managers said the global stocks will be the leading asset class in 2025, while U.S. equities ranked third in the survey at 18%. Gold was second, 22%, which is a big change from the January survey. They do this every month, where U.S. stocks were the leading asset class among fund managers at 27%. But Trump, maybe the elephant in the room, Trump presidency and the tariffs that come with that, sort of the potential for inflationary policies that come with that, mostly tariffs. Um, and then also just the slow moving Fed. And I think that the latest inflation data, as we just mentioned, has a lot to do with it too, that it's becoming increasingly clear that interest rates aren't going to budge, at least through probably the first half of the year. Um, people have, as some people are losing confidence in the US market, shifting to Europe, where, by contrast, interest rates are falling at a much steeper clip. Expected, let's see, European Central Bank has already has lower interest rates at 2.75% and is supposed to or expected to continue slashing to below 2% by year's end. Bank of England's rates are still slightly higher than the Fed's at 4.5%, but they're expected to slash quicker than the Fed this year to below 4% by year's end. So, with already lower rates and maybe more aggressive rate cutting programs, that's one thing that's making European stocks more appealing. Their GDP is expanding from 0.9% last year to an expected 1.1% this year, and that's not much, and it trails the US, which is expected to grow by 2.2% this year, so exactly 2 to 1 faster growth. But that's after 2.8% growth last year. So at a time when the US growth is slowing, Europe's is at least expected to accelerate. And European stocks are cheaper at trading at less than 14 times forward earnings versus around 21 times forward earnings for the S&P. So all of that has conspired to make European stocks popular at the moment, at least. Is that something you see that piques your interest, at least for the rest of the year?
I don't know. One of the things that I keyed in on a little bit, or a couple of things, uh, the German DAX is at record highs or near record highs.
Hmm.
But in 24, Germany's GDP contracted by 0.2%. That was on the heels of a 0.3% contraction in 2023. The expectation is that it could face a recession that could last up to 3 years,
Yeah,
right? Like if you're worried about, I don't know, I guess I have maybe a counter narrative to it. But if you're worried about growth and that's really the driver, I don't know. I don't know if a country going into a recession, obviously
yeah,
Germany is not all of Europe, but it is a big component of them. If you're mostly worried about valuations, I think it's a lot easier to make a case for investing in some of these European companies.
mhm,
If you're largely worried about, the domestic sort of political morass that we're in right now, and you're just worried about lack of stability, that makes European stocks much, much more appealing to me. I think the most compelling case for it is European stocks coming into this year were trading at a really significant discount, like a 20-year discount or a pretty historical discount. I don't have exact numbers on me, to US stocks. So I think that there's a valuation and stability case more than there is a growth case. I would probably,
I agree.
as somebody who's been allocated to European stocks, right? Like as a portion of my portfolio, I've been allocated to European stocks for a long time. I would love to see outperformance. It gives me maybe a little bit of the same vibes that like small cap stocks have given me for the last 5 years, where it's like
Right.
you guys are supposed to do better than you're doing. And I believe
Yeah.
that in the long haul, that will turn out to be the case. But for the time being, it's just kind of frustrating sitting there and watching some of these asset classes underperform
Yeah.
while massive valuations spike in the US large cap specifically.
But I mean, unlike small caps, which have continued to underperform, European stocks are actually outperforming at least through the first, less than 2 months of this year, which has been a rare occurrence lately. The question is, will that continue going forward? I'd be interested to see what these surveys look like next month, April. It could be a prisoner of the moment with, Fed angst, tariff angst. Um, It's interesting to see how this evolves in the coming months.
Yeah,
But
just
all the U.S. uncertainty is a real thing, right now. So it's possible people will just be satisfied to to shift their money to European markets at least for a while.
well, and just to piggyback on the Europe of it all, the Hang Seng up 13% in the last month.
Yeah.
And we saw almost this exact same scenario play out back in October on the heels of like new Chinese stimulus, where the Hang Seng ran up from mid-September to like the first week of October, it ran up 35%, and then it just immediately retreated.
Yeah.
So I do think that, you know, if you're trying to game out a year in advance, I think you'll have your answer within like the next month, right?
Yeah.
If this is sustained growth or if this is just reactionary, where it's maybe a short term, we've talked about that rolling bull market that I think it was Jacob who first used that term on this podcast. Um, if this is just a reallocation by some of the bigger market players where they're taking profits in US growth stocks and they're just parking stuff in Europe and they're not really chasing European stocks,
Yeah.
we should see this settle down pretty quickly. It
Yeah.
certainly wouldn't surprise me, but there is room for catch-up growth. So I
Yeah.
think, maintaining an allocation to foreign stocks is probably smart, but I don't know that you necessarily chase them.
No, and in the end, growth always wins the day. We literally just mentioned that USG or earnings growth was close to 17% through the first three quarters of the fourth quarter earnings season, best since the fourth quarter of 2021. Again, GDP growth, even if it's slowing, is projected to be twice as fast as Europe. So, it's not like Europe is suddenly going to be growing faster than the US, most likely. So, we'll see. We'll see. This could be a temporary phenomenon, but yeah, like you said, we probably will know in a month. Lastly, Alibaba um, is up 17% in the last couple days since reporting earnings. A big reason for that, well, they did beat estimates, is some of their language around their AI, increased capital expenditures on AI. CEO Eddie Wu said, "We're going to aggressively invest in AI infrastructure, spend more in the next 3 years than we have in the past decade." Stock is now up to a 3-year high. Barclays, JP Morgan raised their price targets. Seems like Alibaba is anything AI. AI is the real kingmaker in the market these days. Where if you have a legitimate, even if you just talk about how much you're going to spend in AI, how much AI spending you're going to do, um, the market responds favorably. Um, what's your take?
I am a little bit divided on it because we just saw what happens when you shake up the AI narrative a little bit, right? We saw Nvidia take a big haircut, although it's bounced back pretty significantly, and they still have earnings coming up. We
Has
saw a lot of
DeepSeek angst passed, do you think? Do you think DeepSeek worries have passed, or is that a
well,
just kick the can down the road kind of a thing?
yeah, so that's what my thinking is right. It feels like Alibaba, investors are trying to recreate the thing that's driven the bull market for the last 2 years in the US, even though that just got a little bit of a gut check
Hmm.
from DeepSeek. The the best case that I could make for it would be that Alibaba essentially becomes favored nations. We talked when we had Larry on the podcast last year at some point about how there's a lot of reticence with Chinese leadership in allowing these kind of black box software items like these large language models because you can control the input data and you can see the output data, but you can't understand or you can't see how it gets from A to B. So there's risks of losing control of the data that is within the models. Um, this seems like a complete about face by China in that if there were if there were party control over it and they didn't want to allow for the development of some of this larger AI infrastructure, they probably would have tamped this down pretty quickly. I think the best case scenario, it's something that still has me bullish on Meta, even though they have taken a significant hit since I picked them last week as my best performing stock for the next 6 months, would be that Alibaba essentially becomes the commodified AI depot of China. Where it's like, all
Hmm.
right, if you want to do any AI development in China, you are paying Alibaba to use their servers. They're collecting tolls on all of this. Also, the all of the most cutting edge software in AI for like the last 6 months has been coming out of China. It hasn't been
Hmm.
US software that's been doing it. It has been Chinese software. Uh, I suppose if China sees a real growth opportunity there to sort of edge out the US in a leadership position for this like next generation of software, there's a lot of promise. So this doesn't strike me as like a buy the rumor, sell the news. This does seem a little bit like position building, but I do think it's at risk of the same kind of flame out that we sort of saw when DeepSeek came out, where if the technical underpinnings for
Yeah.
some of these models take a significant hit, then there's higher risk there. But I think ultimately there are enough sort of compelling cases to make in support of it that I like the potential outcome where it becomes their go-to AI name in
Yeah.
China, even if it's just a bunch of smaller companies that are using their tools and piggybacking on them. I don't know chip quality wise what they're doing. I can't imagine that they're just like skirting import or skirting US export rules and buying like NVIDIA GPUs.
Yeah.
I do think if you see like a Chinese semiconductor name pop up that's like new to market and is specifically targeting AI that's not already owned by Alibaba, that's probably a pretty interesting flyer for me.
Yeah, I think this was what this shows is almost a rebuttal of the DeepSeek thing. It shows that AI
Yeah.
still matters. AI still is still the biggest catalyst for stocks on the market right now. If only by default, because there's not any other obvious catalysts that have popped up, at least new catalysts that have popped up in recent months. Alibaba's benefiting from that in the last few days. So yeah, we'll see where it goes. Okay, let's take a quick break and then we will welcome on Nancy Zambell. All right, we welcome on Nancy Zambell, who's chief analyst of Cabot Stock of the Month, Cabot Money Club magazine. Um, Nancy, you track closely investor sentiment. I know it had been trending much more bearish. I think on our staff call, our editorial call a few days ago, you mentioned how low it's gotten. Where is it now?
Well, for the professional investors, the bulls are running about 49.2%, and for individual investors, about 28.4. So they've just kind of reversed. But individuals and the pros often are a little bit different. When the individuals start getting excited about the market, that's when most of us want to get out, to be
Right.
perfectly honest. But yeah, the definitely has turned more bearish, especially on the professional side.
Does that make you want to buy? Are you when sentiment hits a certain point, buy stocks now person, or does it make
Yeah.
you more cautious, or neither?
Yeah, now once it starts going more bearish, that's when I get more interested in it because when it's a really high bullish indicator, everything's just too overpriced.
Right.
I mean, I think we're still overpriced in a lot of areas. We're
Yep.
seeing some sectors come back, but yeah, it's just, but you got to be picky. As I've said for the last 6 months in my newsletter, it's a stock picker's market, and it really
Yes.
is.
Yeah. Yeah. We heard that a couple weeks ago when we had Jacob Mintz and Mike Santolo on. They Tyler London. They all said stock pickers market, and we talked about at the top that just what a tight range the market's been in for the last 5 6 weeks, and whether a breakout might be coming. I don't know which direction. Are there sectors that you like more than others right now?
Yeah, I do like the financials. Of course, financials always have a warm place in my heart because that's the business I've been in for my entire career. But
Right.
they still, I mean, they're up about 6% year to date, but I think they were down for so long that I think that there's probably some good traction there. Healthcare, which is kind of tough because we don't know politically speaking what's going to happen with the healthcare system.
Right.
There's probably still some good biotechs out there, but I'm not a biotech person, so it's hard for me to choose one of those because you have to do a lot of research on them. Energy has come back definitely this year. There's probably some good picks in there. Um, basic materials is up too, but I would be hesitant there just because of what I think is going on in the real estate and the construction industry, which will definitely affect basic materials. But, on the bottom, the stuff that's not performing very well is consumer discretionary and staples and technology. Of course, that's been under pressure for the last year.
Are you looking, Chris and I had just talked about some really strong results out of Europe and Asia. Do you look overseas at all? I know that
Yeah.
predominantly you're US focused in Money Club, but have you been looking overseas at all?
Yeah. I look more at the ETF area because I'm not an expert on anything overseas. But I would say, I mean, Europe has actually started looking pretty decent in some
Hmm.
places. I'd probably stay away from China because who only knows what's going on over there. Um, Carl, of course, is our overseas expert, and I haven't looked recently to see what he's doing. I think he's over there again right now,
Yeah,
in
he's in
Asia.
the Philippines right now.
Yeah.
Yeah.
Yes. I mean, it's always tough, but if you're going to me, if you're going to invest overseas, unless you are an expert in a particular area, you're better off going with an ETF. And there's a lot of stuff you can do emerging markets. You can do what do they call the ones with all the African markets?
Frontier?
Pioneer, Frontier.
Frontier.
Frontier. Yeah.
Yeah. Yeah, those I'd really stay away from because everything is just, I mean, the US's position with the rest of the world is kind of scary right now. So I'd be worried about some of the developing areas, but definitely in Europe, I think that some of those large cap stocks is what I'd be interested in the ETFs.
And of course, the housing market is sort of your bread and butter, is real to yourself. I think it's fair to say you're not overly optimistic about the year ahead in the housing market. The Fed has paused rate cuts, and the 30-year mortgage rate has been hovering around 7% or close to it. Like I think you mentioned before we came on the air that is down slightly for the first time in a while today, but still,
And it went down to 6.59% this morning.
6.59. So that's what the lowest
That's
it's been
pretty
in,
good.
yeah, 2, 3 months maybe. But still, sounds like you're not overly optimistic about much movement in that market in the next, or at least,
No, I
yeah.
mean, it's such a volatile market and it has fairly long bad cycles and fairly short good cycles. And of course, we went through all the craziness after COVID, and during the end of COVID too, with prices and no inventory and sky high prices and people paying $100,000 above market price for a property. That's gone now. Unfortunately, the sellers don't really believe that, so they're still trying to overprice their properties. But we were down in my company about 20% last year over 2023, which is significant, And
Yeah.
as I mentioned to you and Brad earlier, I've just decided to go virtual with my real estate company, as are many, many other companies. I mean, if you look at some of the bigger companies in the US, EXP is one, and United Technologies is one, or yeah, what is it? No, United Real Estate, I guess it's called. Anyway, those are all virtual companies, and that's the way it's going. But all the changes with the NAR last year, with the way that they changed the way the commissions are structured and how you talk about it, that's just been a mess. And that hasn't ironed its way out yet. But yeah, I just don't see, I mean, prices are still elevated. They're still going up in this area. They're going up about 5% per year, less than that on a nationwide basis. But inventory has risen, but now we're looking at 3 to 4 months. In the old days, it wasn't unheard of to have an average of 5 to 7, 8 months inventory. So, as I said in my recent magazine article, which should be published in the next week or so, I think that it's probably a pretty good time for buyers right now. Yeah, rates are high, but let's look relatively speaking. The first home I bought was a 14% mortgage rate and and you can always refinance. And
Right. Yeah, and to your point, I pulled some numbers about 4.8 in January, 4.8% increase in prices year over year. It was the 19th straight month of prices being going higher. It's 396,900 is the national average right now. Existing home sales down 5% in January from December. Although they're up about 2% year over year. Uh, but yeah. it's encouraging at least that the 30-year was down to close to 6.5% today.
Yeah, it probably won't spur many buyers. I mean, they're saying we may just get around 6% by the end of the year, which is not enough to make people just
Right.
bite the bullet and go ahead and buy. You have to have a significant rate decrease in order for people to really jump in. And the other thing is the sellers, many of them that bought in the last 5 years are sitting on a 2% or 3% mortgage rate. They
Yep.
don't have any incentive to get out of that mortgage and go into another one. That
No.
would be silly.
Yeah.
And especially since the equity hasn't built up, and those price increases are interesting because most of the time those price increases are based on listed prices. Well, yeah, we're still seeing listed prices fairly high, but they're dropping, dropping, dropping. Every week I'm getting emails saying, this one dropped 10,000, this one
Right.
dropped 20,000. So sold prices are a different thing.
Yeah. To your point, we bought a house almost exactly 4 years ago to the day. Maybe it is to the day. 2.75%.
Yeah.
So
Don't ever move.
we never will. Yeah.
Yeah,
And you
same
had
boat. I
something.
mean, we're at 3 and change, and we were in December of 21. Um, are you are the price drops the only maybe evidence of like a thawing market that you're seeing right now? It sounds like transactions are still down, and it really does sound like it's kind of a game of chicken right now
It
between
is.
buyers and sellers because, Chris and I, like we just said, if you're at 3% and you bought in the last 4 years, you have no incentive to sell. Like, there's no economic incentive to sell unless you have to move.
Right,
Why
right.
would you
If
do
and
it?
if you're in an area where you have a big working population, then you are going to have, continuing sales because people do relocate. Although today, the whole remote work thing has changed that to a large degree too. I remember years and years ago when I was going through college, I was working at an ad agency, and one of my coworkers, his husband worked for IBM. Every year they moved. Every year he got promoted, and they'd move him across the country, and that just doesn't happen anymore
Yeah, that
unless
was
you're
my
in the
childhood.
C-suite. Pardon?
That was my childhood. My dad worked for a big multinational company, and we moved every couple of years. We'd be in
Yep.
Oregon or Oklahoma or Arizona or elsewhere. Um,
Yeah, so I mean
so
that's changing. So you're not going to have as many houses on the market. I think personally, inventory is probably about as high as it's going to get for the next probably through the end of the year. I just don't think we're going to see any great rise in inventory, barring some crazy thing with interest rates that suddenly the Fed decides to really cut rates, which I don't see that happening because the economy's too strong.
so it,
Right.
it sounds like pick your spots is sort of the name of the game in buying a house, just like buying a stock these days. Whereas
Right,
like
right. I mean, if
find the
you
right
are
house
in,
at the right price and
yeah,
negotiate it, right?
yeah, I mean, if you're in a big city, you're going to see turnover. If you're in a retirement area, you're probably going to see maybe some sales, though not a great increase in sales because most of those people are still holding out too. Um, but when I was out in Hot Springs, Arkansas, a couple of times in the past couple of months, and actually thinking of relocating there, by the way. And it's amazing. They've got some prime spots in that Hot Springs area. I shouldn't say this because I don't want it to get too hot before I buy something. But I mean, they've got some nice developments there, and there's a lot of lakes, and you're surrounded by the Ozark Mountains. I mean, it's really it's a nice spot, and the climate is very similar to what it is here in Tennessee.
And you wrote about some of this in your issue, recent stock of the month this year. Sorry, forthcoming stock of the month issue. You want to expand on, what that's about this month?
Well, that one is about Tom Hutchinson's recommendation of Ally Financial, ALLY, and that one basically is an online bank, and they pay a smaller dividend, but they basically have the online bank industry cornered at this point in time. Of course, there's always going to be competition pop up, but I think they're gonna do pretty well. They were the old GMAC, if you remember that, when GM had their own financing arm. That's where sort of they sprouted from. And they do mostly auto financing. And I mean, I don't know. I mean, auto industry is, 1 month it's good and 1 month it's not good. It's certainly not a barn burner right now. But I think it definitely has some potential. And I mean, I bought a new car last year, and I'm at least every other day I get something from somebody to refinance my car at a lower rate. And I
Yeah.
haven't even looked at any of that stuff, but as I'm sure there's a lot of fees involved with it. But yeah, yeah, that was in the stock of the month. And then in the magazine this time we're really talking mostly about housing and what's going on there, but lackluster, I say.
Yeah.
Is there one of the things having read the magazine, it sounds like one of the things that you were really advocating for is also doing more with what you've got, whether that's remodels,
Yeah.
refinancing, like taking those steps. Any takeaways that you would want to share, or anything that people might not expect for like the remodels, recouping expenses, things like that?
Yeah, I'm just looking, and bear with me a second. I'm looking for that page because the thing, and I don't know, Brad, if you felt the same way when you read it, but when I looked at those prices for renos, I'm like, whoa, because I run these numbers about every 6 months because I also do a real estate column for a local paper. And that's one of the things that people always want to know. Well, if I update my bathroom, how much money can I get back? But I was really shocked at the prices. And this is Remodeling Magazine, so who better to know the numbers, right? But the cost, well, first of all, I had no idea that a garage door cost over $4,500. I guess I've never
Wow.
replaced a garage door, but the return is almost 200%. So that makes sense, right? And then you look at the front door and tell you in real estate, the front door is everything that you look at when you come in the house. And when you obviously you look up above the front door, and if there's cobwebs everywhere, that's a real turnoff for people. But that also was like $2,300 for a steel door. You can get cheaper ones for sure, but that some of the things like the remodels of whole rooms, like a bathroom remodel, mid-range 25,000. That used to be about 10, not that many years ago. And then they said master bedroom, let me find that one. Upscale upscale, that was bathroom. The master bedroom, I think it was adding a room on. Let's see if I can find it here. Oh, here it is. Well, they don't call it master bedroom anymore. It's called primary suite. The addition of a primary suite, a 24 by 16 room, $164,649. Now, you used to be able to buy a house for that, a whole house, not just a room. So, it's kind of interesting to see what those were. But yeah, they took me back. I mean, some of the stuff I knew, like window replacement, that's always going to be expensive. But if you're going to sell your house, you need to have good looking windows in it because people won't buy it because in their head, they're thinking, oh my God, that's a lot of money to spend once I already spent this
Yeah.
money to get in the house. Same with the roof. Those prices haven't really gone up that much, but the other stuff, and I'm wondering if it's because there was such a boom in the building industry, you couldn't find a contractor to do a reno. So the prices have definitely gone up so that it pays them because most contractors, they want to build the whole house. They don't want to do a backsplash in a kitchen or put a new toilet in for you because they don't make enough money on that. So I think that if people are considering doing that, they need to think about how long they plan to be in the house, because obviously you're not going to spend $164,000 for a primary suite if you're moving out next year. That would be crazy. And that I would only advocate that you would do that if you lived in a luxury home. If you're in a $3 million house, then 164,000 doesn't sound that bad. But I think it's just like with stocks. People have to be really picky about what they do, but there are a lot of things, as I also said in the magazine, that you could do that's really cheap to make your house look better, like a fresh coat of paint.
Yeah, the fresh
Right.
coat of paint is the thing that sticks with me as like the highest ROI thing you can do, where you
Mm-hmm.
spend $200 on, 10 gallons of paint and add 6,000 to the value. The flip side of that, at least out here in Arizona, is the pool edition, where you spend 50, $60,000 to put a pool in and you get 60 cents on the dollar back.
Yeah, if
Probably
any,
less of
because
a factor for you guys.
yeah,
So
yeah, some people don't want a pool. It wouldn't,
Yep.
we don't get too many pools around here, but when I lived in Florida, of course, everybody had a swimming pool, but a lot of people don't want it because they don't want the maintenance on them or the liability. They've got up the regulations. You probably have to have a fence around your pool so high with a certain lock on it and all that stuff. So yeah, it's just really interesting. But it's like anything else you do, you have to really study what you're doing and compare prices and don't get one estimate for something. You have to get many. It's sort of like when you're looking at stocks, don't look at one stock, look at 10.
And that issue of Money Club comes out a week from today, next Friday, the 28th. If you wanna sign up in time, you go to the cabotwealth.com website, and under premium advisories as Cabot Money Club, you can go sign up there. You get, every month you get the magazine, as Nancy was just talking about, with a featured segment like housing this month. And you also get stock of the month, which is new pick, and then a portfolio of previous picks that are updated. Nancy, thanks so much for joining us. I wish there was more good news about the housing
Yeah,
market.
me too.
Yeah, I'm sure. But it sounds like, at least with the increasingly negative sentiment in the stock market, that you're a little bit more optimistic there, or potentially bullish there.
Yeah, it's funny because when I got into the real estate business, of course, I've been doing investments for years, and I thought it would be like if the investment business was good, the real estate market wouldn't be so good, and vice versa. But generally, they run pretty close together. But we may be in a window of time here where we're actually better off in the stock market.
Right. Yeah. Well, good thing that's what we're mostly in here.
Exactly.
Um,
That's our
but
bread and butter.
exactly. Nancy, thanks for joining us. And look forward to that issue next week. And thanks everyone for joining Street Check, and we'll talk to you next week.